Hello everyone, welcome to Just Invest Today, and today we have a good video. Today we're talking about this guy saying value investing is over, it's dead. Should we stop focusing on these long-term value plays as this guy said? So I'm gonna go through this article and I wanted to kind of like debunk what he's saying or trying to like see what he's saying, try to understand his position, and see if I can actually combat that. Looking at it from a Warren Buffett standpoint, because you guys know me in this channel, I'm more on the value investing side. So let's see if we can take from what he said and maybe apply some of it, or let's see if he's just full of whatever, full of crap, full of bullshit. So let's get into this article. So, early Tesla backer and top fund manager, his name is James Anderson, attacks Warren Buffett's strategy. Here's his investing advice. So this guy returned, I think, 1,700% in about 2 decades. So that's his investment history. So he's an early backing of these stocks. So let's see what he's about. Let's go through. We're gonna go through this article quickly. One of UK's top fund managers and trailblazing technology investor has criticized value investing and the obsession for short-term metrics. I agree. We are too obsessed with short-term metrics. I think the average person like doesn't even hold a stock for a year anymore because we're so like our minds are so closely related to what the market's doing, ups and downs and whatever sideways. Like we're just too focused on that. So I agree. In the departing letter on Thursday, he said the greatest regret was not making the bigger and bolder bets. Listen to experts and have faith in the forces of change. So guys, we can't always just listen to experts. Like experts have like who are they incentivized by? You don't know who's giving them money, who's doing this. Like, are you listening to a person who's giving these your earnings are gonna be this and that and how they talk about a company, like they can be incentivized heavily. We don't know that, so you can't just blindly listen to experts. Do your own hardcore investment research first. That's what you do first, and then find evidence disproving what you think first. And then you can probably listen to what people are saying, but make sure it's from credible sources. So not all experts. So how forces to change despite severe swings in stock prices, James Anderson said in his report with annual results of the Scottish. Okay. So he enjoyed remarkable gains over his history marked by big early bets on technology companies including retailer Amazon, probably hit it at the park, Chinese internet giant Tencent, electric car company Tesla. Guys, those three companies, like if you just invested in those, you'd be, man, that's crazy. If you get 10 years with those companies and like you invested in like the long run with those companies, man, you hit it at the park. So his shares fell 9% in 2021, up 60% past year. So let's get into what he's exactly saying and see what if we agree on these things or we don't. The only rhyme is that in the long run, value of stocks is the long run of free cash flows they generate. But we have the barest and most nebulous clues at what these cash flows will return out to be. So I understand what he's saying. Because guys, predicting cash flows 10 years from now using a DCF, like come on, how accurate is that going to be? A competitor can come in 2-3 years and take out that company. So predicting these cash flows is not as important as making sure you're buying a quality company that you think has a strong moat that's going to last. That is way more important than getting the exact pricing of what you think the company is going to be 5-10 years from now. Just ask the simple question: do you think this company is going to be bigger 5 years from now? If you're fumbling on that, like what I'm saying, if you're fumbling on that, don't invest in it. If you think about a company like what, Amazon, is this company going to be better 5 years from now? Yeah, like it's immediately it comes, yeah. So predicting cash flows, guys, you got to keep it very, very simple when you're doing these DCFs and trying to predict margins and trying to predict how much taxes are going to be taxed and how that's going to affect their cash. Like, guys, is this company going to be better 5 years from now? Simple answers, simple questions, quick DCFs. right? That's how we're doing investing. Keep it very, very simple, the bare bone. So yes, I kind of agree. So I kind of agree with what he's saying. But woe betide who to think that a near-term price of earnings ratios defines value of era of deep change. So he's basically saying price to earnings ratio doesn't really define the era of deep change now, because I kind of agree and disagree. It's important to make sure you're not buying expensive companies, right? But at the same time, we can't be focused too much on the PE right now, because remember Warren Buffett and Charlie Munger, we were buying these companies cheap. Five, their P's were 5, 10, and lower. Like, think about the strongest companies right now. Like, those companies were probably never selling at those cheap 5, 2 PEs when Warren Buffett was buying like Washington Post and Geico and companies like that. So we gotta understand that these companies are growing faster today. So if a company's growing at 35% a year and you're paying 25, the PE is 25, that's okay. The company's growing faster than what the PE is, so that's not really expensive. The company is really gonna grow, but then you're gonna be cautious on if that company can sustain that growth. So that's where you gotta be very cautious on buying expensive companies with these strong growth. So, since the emergence of digital technology, sustained growth at extreme pace and with increasing returns to scale has become more evident. I agree. Companies are growing faster, at a way faster pace than that. He pointed to the tech giant Microsoft, which continues to grow after 35 years as a public company. So this is a weird thing, because remember, from like 1980s to 2000, Microsoft did amazing, and then 2000 to like 2015, 16, it didn't return nothing. Like, from the peak of that crash, all the way 10 years to like 2010, maybe 15, it didn't do nothing. You wouldn't made any money. So him saying Microsoft is kind of, it's not the best example, because it's Microsoft was still making money, but you bought it at too high of a price. So that's kind of contradictory right there. Distraction seeking minor opportunities and banal companies over short periods is perennial temptation and must be resisted. So he's saying buying these boring companies must be resisted. But guys, think about Warren Buffett and what Charlie Munger thinks about. They want to make sure they're not losing money. That's their first thing they want, not losing any money. Because guys, a lot of people are invested heavily in Berkshire. Their friends, they have their personal wealth in it, family. Their goal is not to do anything stupid for Berkshire so it crashes. So they're investing in these slow, boring companies that are going to continue to generate returns over the long run. Because guys, the game of investing is all about compounding. If you're investing in companies for 5, 10 years, compounding is the most important thing. And if you're investing in companies you don't understand, and they're gonna maybe competition is gonna come and clean them away in 2, 3 years, you're not gonna get that compounding of their earnings and all their buybacks and like, you're not gonna get that. So be wary of what he said. Instead of following what brokers in the media, Anderson advised listening to experts and scientists. So guys, like, what kind of experts is he talking about? That's what we have to kind of, and scientists. So let's see, following expert advice on advances in battery technology was behind Guilford's decision to invest in Tesla early. That makes sense, because if you see that a company has that battery technology and it's the only one doing that, that's the competitive advantage which you can see this company growing in the next 2, 3, 4 years. But guys, with Tesla, everyone has gained that advantage. Everyone has that same advantage now. So Tesla, like, we don't know where it's going to be. We can't guarantee it's going to be the number one number one electric car company now, because everyone has caught up with the autopilot, like battery technology. Everyone who's caught up with that now. So doesn't have a competitive advantage anymore. So Tesla is not like a really trustworthy company going out 10 years from now, because it's almost like a price competitive business, especially with the branding. Like, you can get a nice Volkswagen You can get a BMW electric, like, and those are good brands that can match with Tesla's brand. So you can't use brand of Tesla to overprice electric cars because someone will just go over to BMW or Volkswagen, right? So gotta be wary of that. To us, it's bizarre that brokers, hedge funds, mavens, and commentators can claim to be able to decipher the future and assign price numerical target to the value of Tesla. See, he's just basically saying that you cannot use a DCF with Tesla because you don't know where it's going to be. And that's the thing with Warren Buffett. He doesn't want something that's unpredictable. He's trying to preserve his wealth. He's not trying to lose it. He has enough money now, too, if you think about it. So he's probably not investing in all these high flyers that you don't know where it's going to be in the next 5-10 years. So you got to think about it in that Warren Buffett perspective. Because remember, compounding and staying in the game is the most important thing. So describing what the market's for a great investment, he said at Amazon, it's a founder, Jeff Bezos, as a model. The company should have an open-ended growth opportunities that should work hard, never to define or time, he said. So that's good. Open-ended growth opportunities. You want companies that are growing fast or growing their revenue, or they have a lot of opportunities for growth in the future. Alongside initial leadership that thinks like a founder and almost always is one. So yeah, founder-led companies are going to do better because that's their baby. They're going to want to make sure the company does good. Not someone taking over the company and trying to make as much profit as possible in the short term and just getting rid of it. You don't want companies like that. So let's look at his holdings. So yeah, you can see from his holdings, his top 10 holdings, that he is involved. He's investing into the future. He's heavily investing in the future and trying to look forward. So that's the difference between him and Warren Buffett that I see. Like, he's investing in like all these Chinese local service, Meituan, this biotech, Moderna, EV, NIO, food delivery. Look at that. He's looking at the future. He's buying these stocks with high growth right now. But remember, Buffett is not doing the same things he's doing. He wants more reliable returns that he can see 5, 10 years from now. And on top of that, he's not understanding these companies probably as well as this guy. The first rule is always understand the company. If you can't understand the company, Warren Buffett said it himself, 90% of the companies he doesn't understand, or like 95, so he gets rid of it. That's what he does. He doesn't even look at these companies. So you gotta understand it in his perspective too. So this article is pretty good. I disagree with it, most of it. I agree with some of it, but tell me what you guys think about this article. Do you like it? Do you agree with what he's saying? That you gotta invest in these high growth stocks. Don't worry about the DCF as much. Yeah, so guys, if you like this video, like it, subscribe to my channel. I'll get back to you next video. Peace.